If you're investing in 2026, here's the truth. This is not a market for lazy thinking. This is not the kind of environment where you can throw money at whatever is trending, sit back, and expect everything to work out. The easy money mindset that trained a lot of investors over the last several years is dangerous now. In 2026, the rules are harsher. Valuations matter, inflation still matters, interest rates still matter, energy shocks matter, and if you ignore those things, the market can punish you fast. So the real question is not just, what should I invest in? The better question is, what kind of investor do I need to be in 2026 to come out ahead? And the answer is this: you need to be more disciplined, more selective, and less emotional than the average person. Let's start with the big mistake a lot of people make. They confuse excitement with opportunity. They see a stock flying, a sector making headlines, or some social media guru screaming about the next big winner, and they assume momentum means safety. It doesn't. Sometimes the most dangerous investment is the one everyone already loves. That's why in 2026, smart investing starts with quality. What does quality mean? It means real businesses with real earnings, strong balance sheets, healthy cash flow, durable demand, pricing power, companies that can survive pressure, not just companies that look exciting when the market is optimistic. That should be your filter now. Not hype, not fantasy, not story stocks, actual quality. And from there, the core of most portfolios should still be broad equities. A diversified base still makes sense because over the long term, owning productive businesses remains one of the best ways to build wealth. But here's where people need to wake up. A lot of so-called diversification today is fake diversification. If too much of your portfolio is riding on a handful of giant companies, especially in one sector, then you are more concentrated than you think. A lot of people own index funds and assume that means they're safe. But if the top holdings dominate performance, then your fate is still heavily tied to a very small number of names. That does not mean sell everything. It means understand what you own. Now let's talk about one of the biggest themes in 2026, AI. Yes, AI still matters. Yes, it is still shaping markets, spending, business investment, and productivity expectations. But this is where amateur investors get trapped. They hear AI and think every company attached to that label is automatically a smart investment. That's nonsense. By now, a lot of the obvious excitement is already priced in. So the smarter angle is not just buying the loudest AI names, it's looking deeper. Who is supplying the boom? Who benefits whether the headlines stay hot or not? That means looking at things like semiconductors, computing infrastructure, data centers, industrial equipment, networking, and energy demand tied to digital expansion. Sometimes the real winners are not the celebrities, they're the suppliers, the infrastructure players, the picks and shovels businesses behind the gold rush. That's where you need to think harder than the crowd. Now let's move to bonds. For a long time, people talked about bonds like they were dead, boring, pointless, obsolete. That was shallow thinking. In 2026, bonds matter again because stability matters again. Income matters again. High quality fixed income can play a real role in a portfolio now, especially if you want ballast against volatility. Are bonds exciting? No, but your portfolio does not need every piece to be exciting. It needs the whole structure to work. That's the difference between investing and gambling. Cash also matters, but only to a point. You should have emergency savings. You should have liquidity. You should have enough cash so that you're not forced to sell investments at the worst possible time. But too much cash becomes a silent destroyer. It feels safe, but over time it can quietly lose the war against inflation and missed opportunity. A lot of people sit in cash saying they're waiting for clarity. That usually means they are waiting for permission to buy higher. The market rarely rings a bell and says, now everything is safe, go ahead. You need to learn how to act without perfect certainty. Now let's talk about another thing investors need to watch closely in 2026, energy. Energy is not just another sector right now, it's a pressure point for the entire economy. Higher energy prices can feed inflation, damage consumer confidence, and create volatility across markets. So even if you are not directly investing in oil, gas, or energy infrastructure, you still need to watch it because it affects the background conditions of almost everything else. And then there's gold. Gold can have a role. It can serve as a hedge a diversifier, a piece of financial insurance, but don't turn it into a religion. Gold is a tool, not a